Welcome to Stock Informer for You. The noise in the market is loud, but we prefer to let the data do the talking. If you've been tracking the Indian IT space, you know that HCL Technologies has faced brutal selling pressure over the last few months, sliding down toward its 52-week low. Following its latest Q4 financial results, the stock got hammered. But behind the scary headlines and sluggish revenue growth numbers, something fascinating is happening under the hood. HCL Tech just quietly laid down a massive 1,427 crore bet to dominate India's homegrown sovereign AI space. Is this massive correction a historic value opportunity for long-term investors? Or is traditional IT facing an irreversible structural slowdown? In this video, we are breaking down HCL Tech's latest financials, their massive order book shift, and exactly why international investors are sharply divided on this IT giant. Let's dive in. The financial reality check. Let's address the elephant in the room first. Why did the stock crash? HCL Tech's Q4 results came in at the absolute lower end of what the market expected. While consolidated revenue grew over 12% year-on-year to 33,981 crore rupees, net profit was almost flat, growing just 4.2% to 4,488 crore rupees. The real shockwave came from management's guidance for the upcoming financial year. They project a constant currency revenue growth of just 1% to 4%. Why? Because global tech budgets are frozen. During the final weeks of March, two massive telecom clients in the US suddenly slashed their discretionary spending and multiple large-scale SAP projects were paused. When a multi-billion-dollar giant tells the market that near-term growth is hitting a wall, short-term traders panic and exit. But the long-term story is entirely different. The order book shift and AI deflation. If we look closely at their order book, total contract wins stood at $1.94 billion for the quarter, wrapping up the full year at a massive $9.32 billion. But the management discussed a very critical concept during their latest conference call that every investor must understand: AI deflation. You see, traditional code maintenance and legacy application contracts are getting cheaper. Because of advanced automation, a client's old $100 million contract is being optimized down to an $80 million renewal. This means legacy IT revenue is deflating by 2% to 3%. To combat this, HCL Tech is hunting for net new, highly specialized workloads. The bright spot, their annualized advanced AI revenue has already crossed $620 million, growing over 6% sequentially. They even locked in a massive $100 million plus AI factory deal with a global tech major to build out next-gen AI data centers. The 1,427 crore rupee sovereign AI move. And HCL Tech isn't just waiting around for the West to spend money again. On June 15th, they executed a brilliant strategic pivot by investing 1,427 crore rupees to buy a 10.46% stake in Sarvam AI, making them the lead strategic investor in Sarvam's massive $300 million Series B round. For those who don't know, Sarvam AI is building India's homegrown sovereign AI full-stack platform trained completely from scratch in Indian languages. Their platforms are already running deep-tier deployments, like voice agents collecting data from 17 million farmers for the Ministry of Agriculture. By backing Sarvam, HCL Tech is perfectly positioning itself to monopolize high-security Indian government contracts and domestic corporate AI deployments. Combined with their internal AI rollout, where tools like HCL Force and Google Gemini Enterprise have slashed their own internal IT support tickets by 40%. HCL Tech is proving they can defend their 17.5% to 18.5% profit margins through ultimate operational efficiency, valuation, and the international investor view. So, where does this leave international institutional investors? Right now, Wall Street is split into two camps. Short-term funds are staying on the sidelines because of the slow 1% to 4% growth guidance. However, long-term global asset managers, including heavyweights like JP Morgan, see this correction as a screaming value play. At a current price of around 1,159 rupees, HCL Tech is trading at an incredibly comfortable trailing PE of just 19 times. More importantly, it offers a jaw-dropping dividend yield of over 5.17%. For an enterprise that is virtually debt-free with an ROE hovering over 22%, that massive dividend yield acts as a rock-solid floor against further downside. It literally pays you a high interest rate to wait out the global IT slowdown. The final verdict? HCL Tech is currently transitioning from an old-school legacy IT vendor into an all-weather, high-margin AI systems builder. Near-term growth might look boring, but its defensive metrics, absolute cash generation, and pioneering move into sovereign AI make it a standout portfolio anchor at these depressed price levels. But what do you think? Are you buying the dip on HCL Tech for that fat 5% dividend yield? Or do you think the IT sector slowdown lasts longer? Let me know your thoughts in the comments below. Don't forget to like this video, subscribe to the channel, and hit that notification bell for the latest institutional updates. Until next time, happy investing.